Alright, this is lecture 10.2, continuing the last lecture. We were right here. We were talking about net present value, decision criterion for estimating whether or not a capital budgeting project is a good project to take or not. So we're getting ready to move over to Excel, and we're going to look at these numbers here, and we're going to find their net present value. So the first thing we need to put in here is our weighted average cost of capital, and we'll put it as 12%, which was given in the problem. So from the last chapter we learned that's our opportunity cost. That's how much it costs us. We have to pay our investors that. So we have to discount all the cash flows we make at that amount because that amount has to be paid out. Alright, so now we're going to put another line down here called NPV. And this is basically going to calculate how much we made from these cash flows after accounting for the fact that we had to pay out 12%. So there's an Excel function for this. That might be a little small, but you've done this before. The function is equals NPV. You have to put your rate in first. That's really small, but rate first. So I click that cell, put a comma in, and then I'm going to put in my cash flows. The way NPV works, I talked about this in a past lecture, it's a little goofy. You don't put your year zero in, you put all the others in. Close your parentheses, but then you add in your year zero. Your year zero is always already a negative number. If it was listed as positive, which it shouldn't be, that would be a little goofy, but if it was listed as positive, you would have to subtract it. But I'm just going to hit plus that number and then hit enter. And our net present value is $28,703.96. So how do we interpret that? That means there's equity in this project. It's going to add to the value of our company. So our company is going to go up in value $28,704. That's obviously a good thing. So let's go back and look at our questions. The first one said, if your WACC is 12%, what's the net present value? That's the 28,000, whatever. And then should you take the project? Well, if it's a positive NPV, you take the project. Okay, right off the bat. And then the last question says, how large would the initial investment have to be to make the project infeasible? This is sort of a, we want to do a little bit of a sensitivity analysis just to see how it works. This is real basic. But we're saying, let's just vary one variable. Let's just vary year zero. And let's see at what point does it make this net present value negative to where it's a bad project, where it's actually negative equity, so to speak. If we take this project, we're losing money. The way to do that is calculate the net present value of all the cash inflows, not the cash outflows, just the cash inflows. So if I do that, I go equals net present value, put in my 12% rate, select again just my year 1 to 5, close my parenthesis and hit equal. The present value of just my cash inflows $68,704. So what number would I have to put in here to make us break even? Well, it'd have to be negative 68,704. So if we're just varying that one variable, that would say that if it costs us, if these are the cash inflows we're going to get once we get set up, once we get our business set up, we're going to earn this amount of cash inflows when we start selling. In the last lecture I said we're selling shoes or something. So let's say we're selling shoes. So these are all set in stone. I mean, we're going to make that money once we get the store set up. But if it costs us any more than $68.7 thousand to set the store up, meaning to buy all the inventory and do the marketing campaign, hire the new employees, all that kind of stuff, well, it's not going to be a good project. So that's a real quick example of how you do a break-even analysis or sensitivity analysis with just one variable. Alright, so I've listed these answers on here. So ideally, when you're watching these lectures, I'd like you to try to work through these problems yourself, or maybe you get to the quiz and then you don't know how to do it and you go back and you watch the lecture, but I have all these same answers on here so you can check and make sure you're getting the right answer. Net present value is $20,704. You take the project, it's positive, and then it's going to break even as long as your investment is initial investment's less than $68,804. Let's move on to internal rate of return. Internal rate of return again, is something we've seen before. We saw it back in Chapter 5. It's, well, most of you don't have the finance calculator, but it's one of your basic functions on your finance calculator. For an uneven stream of cash flows, you plug them all in and it backs out an interest rate that basically equates all those cash flows over time. The decision criterion is a little different. If you want to take the project, that means your internal rate of return has to be greater than your average cost of capital. What does that mean? It should make sense. That means your assets are earning more. That means the left side of your balance sheet is earning more than the right side of your balance sheet, basically. And that should add value to your company. So your market value of your company should go up, because what you're investing in is earning more than what you're borrowing at to pay for the assets that are going to earn that. Meaning, let's say we borrow at a 12% rate and then we earn 13%. Well, we're making a 1% profit. That's good. But if we borrow at 12% and make a 9% profit, well, we're losing 3%. And so your internal rate of return, which is the return you're earning on the project, needs to be greater than what you're borrowing at. Okay, so it makes sense, but you do need to remember that rule. So we're going to do the same problem as above, but we want to calculate the IRR. We want to know, should you take the project? And then I've thrown in another question: at what weighted average cost of capital? So let's say this. We said it was 12% earlier. I'm not going to scroll all the way back up there. We said our weighted average cost of capital was 12%. Let's say we're not certain on that, because weighted average cost of capitals are always a little bit of there's a range of error in there. You never really know exactly what it is, mainly because your equity part, you don't know what the cost of capital of your equity is. So let's say we got it wrong. So the question is, if we vary that one a little bit, at what point does the project become infeasible, meaning it's not a good project to take? So let's go ahead and start with the first one. What's our internal rate of return? So I'll go back over here to my spreadsheet. I'm going to go ahead and delete these to make room. With internal rate of return, you don't have to plug in an interest rate. You're solving for it, and the function's actually easier. You just hit IRR equals IRR. You put a parenthesis, and then you just grab all your cash flows. Close parenthesis and hit equals. Oh, came out as a percent. It is a percent. Sorry, but it doesn't have. Move it over one decimal. 41.3%. So that's a pretty good return. Move that over real quick. Oops. Label it. Sorry. So IRR is 41.3%. What was our cost of capital? 12%. We're making way more than our cost of capital. So that's a good project, so we take it. So what is project IRR? 41.3%. Should we take the project? Yes. At what weighted average cost of capital does the project become infeasible? Well, the reason I actually put that in there is just to define what IRR is. IRR, again, is the return on your assets, your project. As long as that's greater than what you're paying to borrow the money to take the project, it's a good project. So the point that it becomes infeasible is actually pretty easy to know. It's 12%. Or I'm sorry, if your weighted average cost of capital was 41.3%. So the IRR doesn't change. The IRR is 41.3. If your weighted average cost of capital happened to also be 41.3, that's the break-even point. So at that point, if your weighted average cost of capital got above 41.3, it would no longer be a good project. You would be borrowing at a higher rate than you're investing at, which you never want to do, obviously. And so your answers are down here. So you don't have to actually do any more work for that one. That's more just to make sure you understand the concept of what IRR is. All right, now there's a problem with IRR, which is why it's common more often to do what's called modified IRR. IRR is a mathematical relationship where it says, if I were to move all these cash flows through time at the same interest rate, what would equate them all to zero? It's sort of like your break-even net present value. That's a little bit of a difficult concept to understand, so let's not go into it. But that's not 100% realistic, because what that basically says is all these cash flows, when we move them through time, we're doing it 41.3%, and then it comes out to a zero net present value. Well, what that means is when I get this $20,000 in year one, I'm assuming I can reinvest it at 41.3%. So if I'm moving it back, when I do the calculation, I'm actually moving this back to year zero at 41.3%, and I'm moving this back to year zero at 41.3%, and this back. But it also means you could move them forward at 41.3%, meaning that you could reinvest them at 41.3%. Meaning that the interest rate that moves money through time, the correct interest rate is 41.3%, and that's not correct. So one way to fix that is to do this thing called modified IRR, which is really similar to the regular IRR. It just, you have what's called a financing rate and a reinvestment rate, and we usually just plug the WACC in for those. And that's the rate that, let me go back here, if I'm going to reinvest this $20,000 until the end of the project, I'm going to reinvest it at my WACC, not my IRR. Because it's more likely if you go out and take a new project, it's going to be closer to your cost of capital. Cost of capital is sort of the equilibrium market rate. That's what the market expects you to borrow at. Well, that's probably where you're going to be closest to being able to reinvest at as well. That's why they require you to pay that on your debt. And so a more realistic assumption is to say, I'm going to take that $20,000, I'm going to reinvest it at 12%, not 41.3%. Same thing with the $24,000. I'm going to reinvest it for 4 years at 12%. I'll take this and reinvest it for that was only 3 years. This one for 2 years, this one for 1. So that when I get to the end of my project, I've been reinvesting these cash flows at 12%, not at 41.3%. And then there's also the possibility, it's very rare, but you could have a project where you have to put more money back in at the future, where you actually have a negative cash flow down here, not just in year 0, but in years 5 or something. It's rare. But then you also have a thing called a financing rate, which means I could borrow that money and wait to spend it in the future. But I'm not going to borrow it at 41.3. I'm going to borrow it at my IRR, my 12%. So, again, that's kind of what I tried to explain here in this short line. Similar to IRR, except cash inflows are reinvested at the WACC, the weighted average cost of capital, and any future cash outflows, which would be future investments you have to make, are financed at the WACC, which you'd have to borrow that money at your 12% in our problem, not at your 41.3. And so there's a function in Excel for this. It's called equals MIRR, modified IRR. And that's real small for you. The first thing it wants is your values. So the original IRR only required the values. That was the only input. But this one, if you hit a comma, it requires 2 other values. This one says the finance rate, then you put comma the reinvestment rate. You can actually put 2 different rates in. You might be able to reinvest at a different rate that you finance at. Probably be more common example would be your finance rate would be higher than your reinvestment rate. This one, and a common way to do modified IRR is you just use your WACC for both of them. So we do 0.12, comma 0.12, close parenthesis, and 25%. And then again, I should have want to label these a little better. And then let me move this decimal over one. So this is actually a much better IRR. IRR is a interesting concept related to NPV because it gives you an interest rate, which we usually quote costs of things and returns of things and interest rates instead of dollar values. And so that's what's nice about IRR. Net present value doesn't have this problem of the reinvestment rate and all that. So net present value is usually the best, but modified IRR actually fixes a lot of that, and it's much better than IRR because it's a much more correct answer of what your actual return on your investment is going to be. So see, it's much less in this particular example. We're not actually earning 41.3 cents on the dollar. We're earning about 25 cents on the dollar, which is still very good and still a good project because we're earning more than 12%. It's the exact same decision rule. As long as we're earning more than we're paying to get the funds, it's a good project. And we're earning about twice as much more, a little more than twice as much more, so it's a good project. Let's head back over here. So the decision rule is the same.